recording, I'm going to be working through the mock test JW Consulting. Please make sure that you have attempted this question before watching the recording. All right, so we've got 15 minutes available to work through the information provided in the scenario. And from an exam technique perspective, we are going to identify positive and negative factors as we read through the scenario. And we are going to mark off all positive factors with a tick and all negative factors with a cross. All right, so let's start by going through the information provided. You are a newly qualified chartered accountant and have recently been appointed by JW Consulting. All right, guys, so here's your future. You've passed CTA, you've passed all your board exams, and you are a newly qualified chartered accountant. So this is what you're working so hard for. JW Consulting provides a range of advisory services to a vast number of clients. To introduce you to the team, your boss arranged for Friday evening drinks at the office. He overheard you telling one of your new colleagues about your friend Frank, who works for a competitor of JW Consulting. After too many drinks, your boss admitted that he is concerned your division will not meet their performance targets for the year. He mentioned that if you can convince Frank to share information relating to some of his clients, he will send you on holiday to his beach house in Cape Town for a week. He suggested that Frank should send through his CV, casually adding that he will override any company policies to ensure Frank is made an offer on more lucrative terms than his current position. All right, so maybe you don't want this as your future. Okay, this sounds pretty terrible as a job for a newly qualified chartered accountant. You sound like you have a terrible boss here, and obviously this is a negative factor there, guys. We have a lot of ethical concerns in this paragraph over here. The following information relates to two clients which have been allocated to you. All right, so first you are given information relating to Furniture Galore Pty Limited. Furniture Galore is a manufacturer of custom-made luxury furniture. The managing director would like to purchase a new, technologically advanced manufacturing machine. The machine will be imported from the United Kingdom at a cost of £4 million. The machine will be purchased immediately. Furniture Galore will have 90 days to test the machine and report any problems to the supplier before payment is due. The machine will be depreciated over its useful life of 10 years. SARS will allow a Section 12C allowance, which is 40% in year 1 and 20% in the next 3 years on the machine. The junior accountant has calculated that the investment in the machine will yield a positive net present value. However, the managing director is concerned about how the following possible changes could impact the NPV calculated. Okay, so he's worried about how the NPV will be impacted if the rand deteriorates, if the SARS allowance changes to 20% per annum over 5 years, and that would be if they decide to purchase a more advanced second-hand machine for the same cost. What will happen if the useful life of the machine decreases and if the discount rate decreases? Then, of the possible changes listed above, the managing director's biggest concern is that the rand will deteriorate over the next 90 days. And he's obviously worried about it deteriorating over the next 90 days because you are told that the machine is going to be purchased immediately. However, Furniture Galore will have 90 days to test the machine and report any problems to the supplier before making payment. So obviously, if the rand deteriorates over the next 90 days, then the machine is going to cost them more. So that's what he's worried about. So he would like to understand how an FEC or a forward exchange contract can be used to hedge this risk. He did some research and he found the following rates. All right, so you've been given the forward rate for 90 days. You've got the bank's buying rate and also the bank's selling rate. So remember, guys, the bank's buying rate is the rate that they will buy foreign currency at, and their selling rate is the rate that they will sell foreign currency at. And the difference between the two is the profit that the bank makes. So you can see they sell foreign currency at a higher rate than what they buy it for. That's how they make their profit. And you've been given the exchange rate over there, the South African rand to the British pound. Then on the next page, you are given information relating to Crazy Stationers Limited. Crazy Stationers manufactures stationery which is sold online with free delivery across South Africa. The company needs to calculate their weighted average cost of capital. To do this, they need to determine the market value of a loan obtained from their commercial bank 3 years ago for an original amount of 6 million rand. The loan qualifies as an instrument and is deductible for tax purposes in terms of Section 24J of the Income Tax Act. They do not understand the implications of Section 24J and have asked JW Consulting for assistance in this regard. The loan is repayable in 6 equal annual installments of 1,337,519 rand, comprising of capital and interest. The market-related pre-tax cost of a similar loan is 10%. All right, guys, so if this is the market-related cost of a similar loan, this is going to be the cost of a debt. And remember, we use the cost of debt as the discount rate when trying to calculate the market value. And that's what they need assistance with. They want to determine the market value of this loan so that they can calculate their weighted average cost of capital. The accounts receivable manager believes that the collection of debtors should be outsourced to a professional service provider. Crazy Stationers would like JW Consulting to advise whether the outsourcing agreement will be cost effective and have provided the following information in this regard. All right, so we can see that credit sales amount to 15 million rand and bad debts are 5% of credit sales. The service provider fee amounts to 4% of credit sales. The average collection period will reduce to 60 days and bad debts will reduce to 2% of credit sales. The bank overdraft is used to fund accounts receivables and the bank overdraft rate is 12.5% per annum. And then you're also given the current debtor's age analysis. First, you are given the percentage of total debtor payments. And if you add those up, you'll see the total comes to 100% over here. So this is telling us that 20% of debtors settle their accounts in 30 days. 35% of debtors settle in 60 days. 30% settle in 90 days. And the remaining 15% settle in 120 days. Then finally, in the additional information, the corporate tax rate is 28%, and you can assume a 365-day year. All right, guys, so that's all of the information that you've been provided with in this scenario.